Have you ever wanted to retire early? Retirement sounds amazing, but it seems so far away. Well, with some simple steps, anyone can have more than enough income in their 60s from investing strategies that don't require any work after the initial setup. So, if this sounds interesting to you, then let's get started. In today's video, we will talk about how you can earn free money by dividend investing. Dividend investing is a strategy that allows you to invest in the shares of stocks and receive quarterly or annual dividend payments from those investments. What are dividends? They are earnings paid by companies to their shareholders as a share of profits, usually on an annual basis. This is one way for investors to earn passive income streams without needing to put up any capital up front. In this video, we will discuss what dividend investing is and why it can be beneficial for your portfolio. Some companies may have a dividend reinvestment plan, often called DRIP, that allows you to choose whether or not the dividends will be taken as cash. Providing customers with multiple ways to interact with your business is almost mandatory these days. Anything less could result in lost sales, which means missing out on future profits and opportunities for growth. If you have a small investment portfolio and are looking for ways to make more money, then this is the perfect plan. It can work well when your dividends are low because of either company growth or lack of stock ownership. When investing in a company, it's crucial that you look for its dividend safety. This means how likely is it that the company will continue paying out high rates of dividends as well as maintaining stable share prices. Researching and assessing the safety of dividends doesn't have to be a time-consuming process. With some quick math, you can do your own research in minutes. All it takes is comparing earnings with dividend payments, basically see how much the company generates versus pays out. If a company earns $100 million and pays out $90 million in dividends, you'll make more of a profit than you would if it only were to pay $30 million in dividends. On the other hand, if it pays out $90 million in dividends and profits fall by 10%, it won't be able to keep paying at the same high rate. Stable dividends in new and risky industries are hard to come by. As you might expect, the more stable an industry is, the less likely a company will need to make substantial changes to its dividend payout ratio when it needs capital for growth or other purposes. The secret to finding great dividend stocks is in their history of stable income and cash flow. Look for companies that have histories of paying out the same dividends year after year, as those are more likely to provide a payout ratio you can count on. Good dividend investors tend to invest in either a high dividend yield approach or a high growth rate strategy. The two have different purposes and are perfect for distinct portfolios, such as the one with an emphasis on stocks that will be yielding income now, but growing dividends over time. The two have different purposes and are perfect for distinct portfolios. With the high dividend yield approach, you'll find yourself invested in companies that have a good cash flow and slow or low growth. The dividends provide for investors who are looking to collect an immediate income rather than do some of the work themselves, like finding stocks with potentially higher returns on investment. High dividends can be a great source of income, but many investors think it's better to buy stocks that produce lower dividend rates and are growing quickly. This strategy means you're buying profitable stocks on sale at the expense of long-term profits for quicker returns in 5 or 10 years' time. Investors may prefer one approach over the other. It all depends on whether their goal is to make a quick buck or if they're looking for something more stable and long-term, like income. When choosing a method, decide what level of risk you prefer. Think about how long you are willing to wait for your dividends to produce your desired level of income. Dividends can provide tax benefits when they are qualified. Income from non-qualified dividends is taxed as ordinary income, but at a higher rate than that of capital gains taxes. Qualified dividend stocks held for 60 days or more will be eligible to receive the lower rates on their earnings. You can't escape the taxman, even if you buy a stock as an investment and sell it right away. If dividends are your goal, then be prepared to pay taxes on any profits from selling those stocks quickly afterward. A crash in the stock market can make even rock-solid dividend stocks fall. The unpredictable nature of this type of volatility means that there is nothing you, or anyone else for that matter, could have done to prevent it from happening. For investors who are looking for a long-term investment, it is worth considering that many excellent companies simply haven't been paying dividends for an extended period of time, such as Verizon, Microsoft, Apple, Welltower. Dividends are an important part of investing because they can help you earn more money in the long run. When you reinvest dividends into your investments by buying shares with them, it allows for compounding effects that mean a higher return on investment, and this is something to be grateful for. The dividend yield is one tool for evaluating the best dividend-paying stocks. Many websites are devoted to helping investors find high-yielding, quality dividends that will grow with time and patience. The highest yields can be deceiving when considering other factors such as sustainability of growth, earnings per share valuation ratios, profitability margins, and stock volatility, among others, which all contribute to a company's overall health worthiness level in relation to its future forecasts. One way that investors can be sure they're getting a good deal on their investments is by looking at the company's dividend payout ratio. This measure removes volatile stock prices from consideration and instead compares how much money was earned to what portion of it went towards dividends per share for each quarter. If, for instance, $2 worth of earnings resulted in a 50% or more distribution toward shareholders as far as paying out dividends goes, then you know you've got something solid. So, how much are you thinking of investing? Let us know in the comments below. If you found this video helpful, make sure to give it a thumbs up and subscribe to this channel. Don't forget to turn on the notification for the latest updates. We hope to see you next time.